explaining a little bit.
I'm really excited now to introduce Larissa Esser, who comes from HERA, who is now going to talk to us about her presentation. So over to you.
Thanks for that, and nice to meet everyone, and really interesting number of presentations. I think let me start by explaining a little bit about HERA, and then going into the content of the presentation that I've prepared for you. So HERA is a flexible hotel operating partner. We engage in hotel investment, in asset management and operations. And really, I think how to place this all into context. We play both in the realms of investment and capital markets, as well in operations. It can happen, or it very often happens, that there's a little bit of a disconnect or a slight moment of lost in translations between operations, operational strategy, and how that translates into investment, and particularly when it comes to synergies between operations and investment. So I think that's where HERA is really playing and really can be that missing link. So my presentation, as I mentioned, it's on hotel capital markets, 2021 themes, thoughts, and anticipated activity. I divided the presentation into three parts. One, I'll start with for sort of a general update, highlighting three key themes which I think are really relevant, as well as some of my thoughts in relation to those themes. Then diving a little bit deeper into actual transaction activity, what's happening, or what has happened rather, let's say in the past 12 months, and then an outlook, what can we expect to happen in the latter part of this year. So kicking off with the capital market update. So I think first theme that I wanted to talk about is that we are not in a financial crisis like we've seen in 2008, 2009. We are in an economic crisis, and we are in a health crisis, but the big difference is that there is actually an abundance of liquidity and capital in the system, both on the debt as well as on the equity side. A lot of money has been raised for hotels and hotel investment. A second big theme is actually that a lot of existing debts within hospitality and hospitality businesses will need to be restructured, or will face some form of restructuring. And for this restructuring, a need of capital is likely, which brings me to two thoughts. One, actually, the need for more flexible solutions and more creative structures. So as opposed to an owner and a hotel, there being a challenging situation, and a sale being an only option that is not. There's a whole array of other options available as well. However, you do require slightly more flexible capital in order to enable that. And also banks will actually play a very pivotal role in this whole process. So what we have seen, banks have not taken a lot of action or put a lot of pressure yet on borrowers. Also, there's been a lot of support coming from the governments to businesses. So there hasn't been that pressure yet. There's been a lot of focus on recovery and a way out of COVID. But at some point, banks will need to meet the market. Also, what banks have done, as they do every year in December, they have their year-end valuations. What these have shown is that on average, value drops of 10 to 20% were a reality, in some cases even more. So what banks are really looking at, one is which borrowers, what is their track record, were they already in trouble prior to to the COVID crisis, and what is their prospect of recovery. And also the end of March, the end of Q1, will sort of coincide with the expiry of a second 6-month extension for a lot of loan agreement waivers, deferrals, and other concessions that borrowers have been able to negotiate with banks. So that's another moment where banks will have to start to take action and be put under a bit more pressure. So these situations, either there is indeed a forced or administration sale or a consensual sale. However, as I mentioned before, in terms of that more flexible capital, a borrower can also look to top up equity or to sort of recalibrate the debt, the covenants, both on gearing as well as on coverage ratios. So what kind of flexible solutions are out there? So private equity, for example, can come in with forms of mezzanine debt, can come in with forms of quasi-equity. There can be sale and leasebacks. So for example, recently on a hotel in Madrid, the owner sold off the real estate, but negotiated a buyback option, so that becomes a debt instrument as well.
Third-party platforms within the hotel industry,
as well as sort of more joint ventures and recapitalizations. So again, as I mentioned, the third theme, private equity, is likely to has been on the forefront of activity and is likely to continue to be on the forefront of activity. One, because they're more flexible, but also because they can be more focused on total returns. So not just the cash flow and the income coming out of the business today. It's very likely that hotel performance won't get close to 2019 levels anytime soon. We heard in previous presentations, that can even take up to 2024. But in the meantime, a private equity investor can focus more on also repositioning, have a more opportunistic business plan. But equally, sort of more high net worth individuals, family offices that have a counter-cyclical approach to investing will now have an opportunity to buy assets that may not have come to the market hadn't it not been for COVID and the distress. So they have also been active and have acquired assets in previous months. So a little bit more on the transaction activity. So what have we seen in the past sort of 12 months? Of course, as compared to 2019, 2020 seen a substantial drop in investment volumes in Europe, sort of a 60% drop from 25 billion to 10 billion. However, we do anticipate that 2021 will be better again. The year sort of started off briskly with a lot of assets coming to the market. However, not a lot have transacted. One, because of a persisting bid-ask spread, so buyers and sellers not being able to meet on pricing, but also traditional bank lending being a bit scarce and alternative debt being a bit more expensive. The real distress deals have also not occurred yet, as the government support and lender protection measures have kept things afloat for the time being. Those deals that have occurred are also a bit more creative and in the OpCo, so operational companies, merger and acquisitions, as well as development space. So, for example, the largest deal that happened last year was in the US, whereby an operator, Highgate, acquired actually or assumed the debt on a big portfolio owned by a company called Colony Capital, 2.7 billion in total, and only very little cash changed hands. They had to inject only a fraction of what the debt was back into the business, and that actually became the largest deal of last year. So I think again in terms of transaction activity over the next couple of months, apart from distress and resolving over leverage situations. I think other drivers of activity involve, and that we've seen quite a bit in the Netherlands with HERA as well, families and particularly different shareholders within the business, with interests no longer aligning, family members wanting to exit, have had enough of all the sleepless nights over the business, but also retirement planning. So recapitalization is then both a way of restructuring that as well as providing capital for growth. I think it's a little bit what will give way to a higher flow of deals if there's a sort of more of a pricing discovery, and what is pricing really today. I think what that requires is that some initial deals whereby an owner decides to sell maybe for a little bit less than what they would like, but ahead of the crowd, whereas a buyer may be willing to pay just a little bit more before they start competing with the rest of the world and the wall of capital that has been raised and is waiting to be deployed. And that is not too dissimilar from what we've seen in the previous global financial crisis as well, where like a period of sort of 12 months of inactivity was suddenly followed by a constant stream of deals, both in terms of portfolios and single assets. So we expect that more deal flow will come in the latter part of the year. That said, the expectation that there will be deep discounts or that prime assets in particular will be sold at discounts is unlikely. In our view, or my view, the buyer competition will keep pricing respectable, and I do not expect very large discounts to be available. However, where there may be discounts is on the maintenance and capex and the adjustments on that front, as obviously in the past 12 months that hasn't been a priority to owners and their businesses. So a little bit around, to conclude the presentation, around where specifically do we see, or does HERA see opportunities when it comes to hospitality and hospitality investment, and this has also been echoed by the capital markets and investors. I think definitely key themes here are leisure, domestic focus, as well as affordability. So, for example, here in the Netherlands, a large fund out of the US called KKR acquired Roompot, which is a caravan park for €1 billion last year. Also, quite recently, another US private equity fund, KSL, acquired a company called Suns Hotels in Croatia, very much leisure focused, beach type of resorts. Also redevelopments, repurposing. So another example of a transaction in that space that recently occurred is again, US private equity Starwood Capital acquiring the St. Petri Hotel in Copenhagen for a total of 144 million, also for the purpose of redevelopment. And I think what is interesting to note in all of these deals, the sellers were actually locals. So what we also see as an opportunity is that, and this is also again matched in the investor interest, is sort of a diversification away from only short stay income to longer term income. I think Michael Ross alluded to that as well, also in his presentation, that demand patterns have changed or are continue to change. So corporate travel, less frequent, but potentially staying longer at destinations and in combination with leisure. So to this end, also a lot of new concepts have been developed. City ID is one of those, an apart hotel brand originated in Amsterdam, backed by APG, who plan to invest 500 million to grow and develop that business. So definitely an interesting trend there. And I think lastly, another opportunity where I think is room for is there's still a lot of chains that are quite small, that have been quite badly hit by COVID, but at the same time, now is the time to grow. So there is in our mind an opportunity for consolidation, a merger between those chains, potentially coupled with a public listing. I think to conclude this presentation, I think holistically there is a lot more potential for operations and capital to continue to work together and continue to reevaluate what role real estate plays in society, and particularly how operations and hospitality and services can optimize that. The ways in which we live, work, and choose to spend our leisure time are vastly different than what they were, let's say, even 5-10 years ago. And equally, I think there's a great opportunity for greater collaboration also with public and private sector, particularly on themes like sustainability and the likes. Good. That was my 2 cents on the investment side and the capital market side of things. And to conclude today's range of presentations.
Thank you, Larissa. It was really fascinating. There's so much information there. And we have got a couple of questions. But firstly, I just want to say something. You know, the thought that you've got there, that reevaluation of the role of real estate is fascinating. You know, the change in how we live, work, play, you know, all of it. And it kind of really feeds into the convergence of different hospitality verticals as well as others, you know, co-working, co-living, co-staying, you know, all of it. And I'd love to hear more about that. But we've had a question, and the question is, you know, when is the best time to take action? Do we wait longer, or do we do it now?
So no, I think in my view, the window of opportunity is now. My view is, and I think a lot of industry peers would share that with me, is that we are looking at a full recovery of our industry, maybe not exactly the same, but it will recover. There is a wall of capital waiting out there to compete with you, and a great selection, I think, of creative opportunities out there at the moment. So we would say, you know, with full confidence and conviction, go now.
Great, thank you. And I've got one final question, but it has to be quite a quick answer. Do you think it's going to be easy or difficult for the industry to change?
Change in what respect?
Well, just to develop and change, you know, the way that it needs to, or the way that it could, over because of everything that's kind of happened with COVID and things. You know, is change easy or difficult for the hotel industry?
It's I think we have shown and that we are very adaptable, we're very creative. I mean, when the COVID pandemic started, you already saw these things like, you know, hotel rooms were changed into co-working spaces. But equally now in the Netherlands, I mean, we're still in lockdown, and, you know, restaurants are now serving dinners on parking lots and things like that. And I mean, I think change on the operational side is easier. On the capital side, it's more difficult. I think private equity, again, like I said, can be more flexible, can be more creative, have less restrictions when it comes to their capital. But traditional investors, it's difficult because they have designed their investment strategies, they have set up their funds following those strategies. So they cannot just go out and invest in something creative because it doesn't meet the criteria, and they cannot explain that in their committee. So there's unfortunately a bit more rigidity within our lovely capital world. But I think on the operational side, I'm astonished each time to see how creative we all are.
Brilliant.